And today we're going to cover this chapter 2, which we're going to start recording the business transactions. Last week, what we did is we start recording the business transaction on the very simple way on that Excel spreadsheet by showing increase in the assets and increase in the liability, increase in equity. Today, we're going to see another way to show everything that we did last week. And we can even go back and that's my idea, to go back to there's a few slides of chapter 1 that I want you to cover, but with the perspective of what we're going to learn today about the transactions. So what we learned so far, we learned that accounting is an interesting thing, collecting information on one place, then analyzing and information, extracting that information and preparing financial reports. Who's going to use the reports, financial reports? For different purposes, different people. We're going to have internal users and we're going to have external users. Financial accounting is the one whose purpose is for the preparing reports for the external decision makers, which will be anyone who is not inside of the company, or maybe some people inside of the company, they might use them, but they will be more interested on different reports. That will be mostly investors and lenders and some government and Canada revenue, obviously. Those will be interested in our financial reports as part of the external users. For the internal users, however, we're going to prepare them some management reports, which will be more specific reports, going to give you more ideas and more detail with more information for decision making. Now, what else we learned? We learned that you can form three forms of business. You can form proprietorship, you can open the partnership, and you can open corporation. The difference is that proprietorship is a single owner, partnership is more than one. Individuals getting into the partnership, and the corporation can be one and can be many. The other interesting thing is that the corporation is the only one who is separate from the owners. All the other forms of business are owners is the business, and that's create the liability. And for the tax purposes, individuals paying taxes on the proprietorship and partnership, and the corporation pay taxes itself. Then we saw who set up the accounting rules. What accounting rules is, what is the fundamental characteristic of the financial information, which is comparability, reliability, verifiability, and fairness of the information. And for that reason, we have concepts. We have qualitative elements, quantitative elements. We have a different elements of the financial information, which is grouped by assets, liability, equity, revenue, and expenses. We already saw that the assets is the financial resources that the company has. Liability is one how can I explain this? That will be one way to get the resources. Liability, one way to get the resources. The liability is something that the company owes to the outsiders. And the equity is the investment that the owners owe. So that's another way to company to get those financial resources, which they need to operate. And that means that the equity will be the obligation that the company has to the owners or to the investors. And then we start doing some basic transactions for the company by showing them those. I'm going to answer those questions in the chat room. I've seen the question, but let me go a little bit deep in the core today's lecture, and I'm going to answer those questions as well. So that we did some transactions related to the first month of the company. Today, we're going to change a little bit the presentation. Last time you saw in the Excel spreadsheet, we put it in one column, plus, minus. Every time when we have increase in cash, we adding the cash. Every time when we decrease the cash, we put it in the same column, but with the minus. Today, we're going to do some a little bit changes in that area. And we're going to eliminate those negative amounts that we put in last time. So let's see how that's going to happen. First, now this chapter is about the recording business transactions. So we're going to set up a way how to record the business transactions. Let's go with the accounting cycle. What we're going to do, we're going to start the accounting cycle. How the accounting cycle works. First, obviously, we have to have a company. Second, we have to have a transaction. So that company has to start operating. When the company starts operating, we're going to have this flow of the information. Start with the balances of the ledger and the beginning of the period. So basically everything, as you already know from your bank account, every month, bank accounts start with balance. When you first open your bank account, the balance is 0. After that, month after month, that balance carry forward. So that's the same thing happen with the company. Now, the company is not going to have only one account. Let's say the accounts that the company have is like, imagine yourself, you having 5 different banks. Your money are spread between 5 bank institutions. In every bank institution, you're going to have accounts. So you're going to have 5 accounts. When you open the first account, the account's going to start with 0 balance. And after that, when you start transactions happen, money coming in, money going out, that will accumulate balances, which balance going to carry forward. Same thing with the company, but they're not going to have 5 banks. They're going to have only 1 bank, but they're going to keep track of everything that they have in the separate account. So cash will be in 1 account, inventory will be 2nd account, equipment will be 3rd account, liability will be 1 account, bank loan will be separate account, the owner's investment will be 1 account, and keep going. So for every activity, for every different setup of assets and liability, the company is going to open new account, because we want to keep track of everything that the company has in terms of assets. And we want to find out from where those assets come from, either from liability, either from equity. So once we do that, once we open those accounts, then we're going to start seeing what happened in the period. There will be transactions, purchasing, selling, anything related to the operation of the company. So we're going to identify, analyze every transaction when the transaction happened. Then we're going to record that transaction into the journal. Then we're going to post from the journal into the ledger account. Then we're going to prepare unadjusted trial balance. That's our job today, to start with the transaction, record the transaction in the journal, and post this journal into the ledger account. And we're going to see how the trial balance, is going to come. After that, next time we're going to start doing the journal entries and prepare the adjusting trial balance. That will be chapter 3. And the chapter 4 will be prepare the final financial statements, journalize the closing entry, and preparing the post-closing trial balance. That's what we're going to do all the way to before the midterm. So again, on the identifying and analyzing the transactions, we're going to start. We already started with the transactions last time. Now we're going to start identifying again. We're going to repeat that process. Then we're going to record the transactions into the journal. We're going to post that journal into the ledger account, and we're going to prepare unadjusted trial balance. Next time, we're going to start journalizing the post-adjusting entries, preparing adjusted trial balance, and preparing financial statements. And following time, in class, when we start in class, we're going to journalize post the closing entries and prepare the post-closing trial balance. So let's see. Let's start first with the first. What's the account? What's the journal? What's the ledger? What's the trial balance? All accounts. Now we have to see the system, how the accounting system works. Account will be analyze the transactions which identify changes. So for example, we're going to have one account for the cash, one account for inventory, one account for accounts receivables, one account for equipment, one account for accounts payable. And inside that account, we're going to keep track of what's happening there. If we have cash, from where the cash come from. If cash going, where the cash going. How much is the beginning balance? At the end of the month, how much cash we have. Same thing with the inventory. Inventory, we're going to keep track of. Do we have beginning balance of inventory? Did we purchase? How much of inventory we used or sold? What's the ending balance? Imagine this, we have a coffee shop. How many accounts we can have? Many accounts. We can have one account for the cash. Do we need to know how much cash we have? Absolutely. Then we're going to have account for the inventory. What inventory we're going to keep track? Coffee, milk, cream, napkins, paper cups, some straws, everything that is possible. Do we need that? Do we need to know how much of those we have? How much coffee we have? How much milk we have? How many paper cups we have? Yes, we do. Why? Because how are we going to run business if we don't know those? So for that reason, we're going to keep track of everything. And we're gonna keep track. When we purchase coffee, how much coffee we use, how much coffee we have. When we purchase coffee, how much coffee we use, how much coffee we have. Same thing like you open your fridge. Open your fridge, but let's say your fridge is one account. But inside that account, you can see so many items. And when you see that you're running out of milk, you're going to purchase new milk. And you're going to add more. And once you're using the milk, you're using the milk. So technically, we want to keep track of what we have, what we don't have, when we purchase it, how much we used. Journal will be account record, which you're going to put all the transactions, which first will be in the journal. And those will be in the chronological order of the transaction. What means chronological order? That will be by date. Basically, we're going to start. Today, I purchased 3 kilograms potato. For those 3 kilograms potato, I paid $3. Also, I purchased 1 chicken. For the chicken, I paid, because of organic, free range, this and this and this, I paid $20. So what you get, what you spent. What you get, what you spent. Next one will be the ledger. Ledger will be we're going to post the data to the ledger like a binder, and which binder we're going to present each account. So in the ledger, we're going to have different binders. In the different binders, you're going to have all the different information. So at some point, you're going to see how much potato you have, how much chicken you have, how much tomato you have, how much rice you have, how much sugar you have, how much flour you have. Everything will be inside, and you know how much you have. And then we're going to prepare this trial balance. We're going to extract now information from the ledger, because inside the ledger, you keep track of the flour. I bought 10 kilogram flours. then I make 3 cakes. For those 3 cakes, I use 1 kilogram flour or 2 kilograms flour. So left 8 kilograms. And waiting for the next event to happen. So but that's on the ledger. So in the ledger, we're going to keep track of everything, how much we have, how much we used, do we need to purchase, if you purchase, how many come, how much we used here, how much we used there, how much left, and keep going. On the trial balance, we're going to list everything and we're going to keep it visible. Currently, I have 5 potatoes, 3 tomatoes, half chicken, 2 kilograms flour, 1 kilogram sugar. This is what I have. If I want to see why I have 3 tomatoes, I'm going to go to the ledger and I'm going to see I have 3 tomatoes because on May 10, I purchased 10. Well, in the evening, I used 1. On next day, I used another 3. On the next day, I used another 4. That will be another 3. That's why I have 3 tomatoes. So if you want to find why that on the trial balance again will be a list with everything that you have currently. If you want to find out why I have this, then you're going to go to the ledger and you're going to see from the ledger, you're going to pull the journal for that particular account and you're going to see what's inside, from where that came from and where did you spend it. So that will be the whole organization. Again, watch this. We're going to have the accounts. All the accounts, we're going to have a journal. For every account, you're going to keep a journal. All the journals, you're going to keep it in the ledger. But on the ledger on the top, you're going to have a list of everything that you currently have. So if you have, let's say, $50 cash, you're going to ask, why do you have only $50 cash? Then you're going to open the ledger. You're going to go to the cash account, and you're going to see all the journal entries there. Journal, you're going to look at the journal and the entries that you made to the journal. On this day, I withdraw that much cash. From that cash, I paid that much. I paid that much. I paid that much. That's why I have currently $10. And you say, oh yeah, I remember. I remember spending this money. I spent this money. Okay, fine. I understand why I have only $10. So now, to make it account, to make it like a company, we're going to keep track of cash. We're going to keep track of accounts payable. We're going to keep track of the capital. All the accounts, again, are going to be put in ledger. And on the top of the ledger, you're going to have a list of everything that you have currently inside. That's why, I don't know if you know, there's a new fridges now, which fridge have a screen. And on the screen, keep track of everything that you have and what's the quantity that you currently have. So before you open the fridge, you're just checking, okay, I already know what I have. Right? That will be the smart system. So that will be our trial balance. So what we're going to do? First, before we do that, before we combine this ledger, obviously in the ledger, we're going to put all the accounts. But what we're going to do, we're going to put it in some order, not like a randomly accounts, but they will be in order. In order to put them in order, we have to make a list. And all the accounts will be listed with the number. So we know when we see those numbers, this corresponded to that account. That means this. So what will be the numerical order here? Out of the accounting equation, which you remember the accounting equation was asset equal to liability plus owner's equity. And we already find out that what increasing the owner's equity is the revenue that company generates from the operating. And what reducing the owner's equity is the expenses that the company incurred to earn that revenue. Same logic we're going to apply with the numbers. In order company to operate, they need assets. So the assets are going to come first. We're going to put for assets number 1, always. Now, what will be the after numbers after 1? It doesn't matter, but account number for the assets always going to start with 1. Once you see 1,000 account 1000, that means asset. When if you see 1020 asset, 1300 asset, 1400 asset. That's with the assets. So what we're going to do next? Next thing that we have is asset is equal to liability. So if the asset is first, liability is second. So every time when the see account starting with 2 at front, liability. What will be 3? 3 will be the equity because asset is equal to liability plus equity. Equity with number 3. Every time when you see account number start with 3, equity. Then next on the line will be what increasing the equity? Revenue. For the revenue, we're going to put number 4. Every time when you see account with starting with 4, that will be revenue. And the last in the line will be expenses. Why? Because the expenses reduce the equity. For the expenses, we can use account 5. We can use account with number 6, 7, 8. Everything is given to the expenses. Once we resume the class, once we go back to class, I'm going to give you one document which is going to look like this. I'll show you here on the screen. And you're going to have it on one page, and that will be given to you. So once I give you that chart of accounts, which I'm going to show you here. Once I give you the chart of account, I'm going to print it for you and I'm going to give it to you. So once you have this chart of account, I would ask you to have this chart of account always with you. It's going to look like this. Assets. And I'm going to print it cover so you can see it. Assets always going to be in green. And every account for the assets is going to start with 1. Then you're going to have number 2 will be liability. And all the accounts will be listed with number 2. Then we're going to have number 3, which is equity. Not many accounts for the equity, as you can see. Then we're going to have number 4, which is revenue. Also not many accounts for revenue. And then we're going to have 5, 6, 7, all reserved for the expenses. First, we're going to have this section, cost of goods sold. We're going to explain a little bit later in chapter 5 what exactly is related to cost of goods sold. And then we're going to have other operating expenses, which are for the normal operating cycle of the company in order to generate revenue. And once I give you this sheet, I want to have it always with you. During the tests, during the quizzes, during the exams, when you take it, always with you. In the beginning, I want you to have help with this chart of accounts. Why is chart of accounts? Because on one place you can see example of different accounts. And so every time when you're wondering, is this account asset or liability? Check the chart of accounts, see if it's here. If it's not here, that means we have to add it. So this is not the final version. This is interactive version. So every time when you see the account it's not on the chart, let me know. And I'm going to add it to the chart and we're going to print it again until we have a full set of accounts. This is descriptive. This is not a mandatory. This chart of account, this is the number of the organizations is descriptive. So once one day when you become accountant and when you want to create your own chart of accounts, those will be the accounts that you're going to use into your normal operation. You can create you can change the order. You can put whatever account you want first. Right now, the accounts here are listed by liquidity. What that means is the most liquid account is always first. And since the cash is the most liquid, always going to be first. So that will be the chart of accounts. We're going to explain more about chart of accounts when the time comes. Let's go back now to the slides and continue with our slides. So that's the organization. One for assets, 2 for liability, 3 for owner's equity, 4 for the revenue, 5, 6, 7, 8 for the expenses. And again, once you see the chart of account, the one that I just show you, you're going to see the assets are with number 1 up front, liability with number 2 up front, equity with number 4, revenue, equity number 3, revenue number 4, expenses 5, can go 6, can go 7. Now, that's for the chart of accounts, and that's for the accounts, that's for the ledger. How are we gonna organize everything? How are we gonna keep track of the changes in the accounts? What we're gonna do is, we're gonna do this double entry accounting. Now, we saw last time double entry. Double entry means if on the accounting equation, asset and liability, if one account is affected on one side, there should be another account affected on the other side. So the other thing is nothing comes for free. You have to understand this. For everything that you have in your life that's come from somewhere. So we're chasing what you get and from where that come from. You can use the same idea with energy. So energy in life, as you know, it just doesn't disappear. It just converts from one energy to another energy. Same thing with the flow of the cash. It doesn't disappear. It just converts from one thing to another thing. But we're using the cash to convert it into something else. Because at the end of the day, if you only have a cash, I know most of you, we want to have cash, but or money. We cannot live with only money. You need something else. If you get cold, you're not going to wrap yourself with cash. You're going to buy a coat and you're going to wear a coat. If you want to eat, you're not going to eat cash. You're going to buy fruits, or you're going to have vegetables, you're going to cook a meal, and you're going to eat the meal. So now question is from where that meal came from the cash. So basically, you're getting the vegetables going to increase because you have them, but you don't have the cash anymore. So that's what will be the journal entry in transactions. Transactions always going to affect two accounts. If the inventory goes up, something has to go down. Most likely cash, if you're paying cash. If you don't pay in cash, then the liability is going to go up. Why? Because you have to pay later. So, example will be the cash purchase of supplies. What's the dual effect? Again, on one side, once we buy the supplies is going to increase, but they not magically increase. They increase because you spend cash. So what's going to happen? Cash going to decrease. If the business purchased the truck, well, now, before they purchased the truck, the company didn't have the truck. When they purchased the truck, now they have truck. Before they purchased the truck, the company has cash. After they purchase the truck, the company has the truck but doesn't have the cash. Or let's say that, okay, the company doesn't have enough cash, so they have to borrow money from the bank. before the purchase the truck, the company didn't have the truck, but didn't have bank loan. After they purchase the truck, now they have the truck, but now magically they have a bank loan, so they have to pay the money back to the bank because they purchased the truck. Right? Always going to treat this way the transactions. What we get, what we sacrifice. So for that reason, we're going to need this T account. Now the T account is something that will be on the ledger inside. We're going to make a journal. In that journal, we're going to have T accounts. Now the T account representing simply left side and right side. Now depends on what kind of account we have. We're going to have different rules. So just for a second, for that, I'm going to open one Excel spreadsheet just quickly, and I'm going to show you something there. Let me bring you to that Excel spreadsheet. So imagine this, we open the company. We're going to have a different T accounts. The T accounts are going to be looking something like this. What will be the interesting of the T account? Now, for the different purposes, we're going to have a different accounts. If you see account with the beginning balance and ending balance, that account will be balance sheet account. If you see something like this, that will be balance sheet account. Why? Because that ending balance is going to go to the balance sheet at the end. If you see account, simple account, sorry, wrong one. If you see simple, just this type of account, that from this side, and then with that kind of account, that will be income statement account. Now, this account is not going to have beginning balance, it's not going to have ending balance. But inside of the account, we're going to accumulate something. So whatever we accumulate, that will be part of the income statement. So the income statement is going to use those cumulative accounts, which don't have the ending balance. And at the end of the period, those accounts are going to disappear. All the balance is going to disappear. And we're going to have a balance sheet accounts on which balance sheet accounts we're going to keep the balance, and we're going to carry it forward for the next period and next period and next period. Balance sheet account, simple example, will be your cash account, that your bank account that you have. Why? Because always have a balance, always have a balance. So for example, at the end of the year, let's say December 31st, the bank's not going to say, you know what, today is December 31st, end of the year. So withdraw your money, zero your account, and on January 1st, put the money back, and we're going to stop keeping track of those money. That's not going to happen because that's not practical. That account always going to have balance. But now imagine the revenue. We want to keep track of the revenue for the period of time. And once that period of time pass, I want to keep track of new revenue. So imagine if that revenue account always have an imbalance. So if you ask me, hey, how much is my revenue in May? What I have to do, I have to see how much revenue is the total minus the beginning balance of May, and then that's too much. So that's why I'm going to keep the income statement account for the revenue only for month of May, and I'm going to tell you, for the month of May, you have exactly that much revenue. How about June? I'll tell you exactly how much you have. How much is my revenue for the entire year? Boom, revenue for the entire year. How much is my ending revenue? That doesn't make sense, right? But how much is my ending balance of my cash? How much cash I have right now? You have that much cash. From where that cash come from? Because you have revenue. How much revenue generating for the year? That much revenue. So makes sense. For the different purposes, we're going to use different accounts. So now let's see. The balance sheet account is going to look like this again. But for the balance, in order we to be in balance, that means when we say balance, what we're going to keep in balance? We're going to keep in balance the basic accounting equation, which basic accounting equation was simply, let's make it bigger now, was simply asset equal to liability plus equity. So what that means is we have to have one account for the assets, one account for the liability, and one account for the equity. The other thing that you can see here is, here we have a asset to be equal. So you have this sign of equally. If we take a look the equally and I put this thing, watch me now carefully, what I'm gonna do. If I put this line here, and when the equally is, I'm gonna draw the line down. Doesn't this look like now as a T account? Let's put this one down so you can don't disturb our view. So once we look at this, asset equal to liability and equity, when I put the line on the top and line on the middle where the sign of equal is, that exactly look like a T account. So what conclusion we can make from this? Now the conclusion is, from every balance for the asset account that we have, it's going to be part of the total assets. Every balance that we have for the liability account will be part of the liability balance. Every balance that we have for the equity account is going to be part of the equity. Now, inside the assets, we can have a different assets account. But what will be interesting? Interesting will be that on the balance sheet account, all the assets accounts, we're going to have beginning balance and ending balance on the left side. So now, for that reason, we're going to add a little bit more information here. Everything that goes on the left side is going to be debit. Everything that's going on the left side is going to be credit. So what that means? That means the balance sheet account, which belongs to the asset, always going to have debit balance. Debit means we have it available. So what that means is every time when we purchase something as assets on the debit side, that's going to give increase of the debit side. And every time when we use the assets, we're going to put it on the credit side, and that's going to reduce the assets. But that applies only and only to the asset account. Now let's see the liability and equity. Since the liability and equity are on the other side of the T, they're also going to have a balance sheet account. Right? They're also going to be balance sheet account. But the debit and beginning and ending balance is not going to be on the debit side. It's going to be on the credit side. So here we're going to have beginning, and here we're going to have the ending balance. So what that means, if we put the debit and credit on the top, and here credit, that means that let's make it bigger a little bit. That means every time when we have a credit, that's gonna increase. Oops, not there. I want it right here. That's gonna increase the balance of the liability or equity account. And every time when we have a debit, that's gonna decrease the balance of that liability or equity account. Now, what will be the simple example here? Simple example will be the owner invested $100,000 cash. So what's going to happen in that case? Company is going to get cash, $100,000, and the cash is going to go up on the debit side, and we're going to call this account cash in this case. So now we have to be in balance. What that means in balance? Means that on the other side of the equation, we also have to make a record for $100,000. Now, which account we're going to use? Since the owner investing, that will be owner's capital. But since the owner's capital increasing on the credit side, let's merge those cells. Since the owner's capital increasing on the credit side, that's going to increase the credit with $100,000, same amount. We have to keep it the same, otherwise we're not going to be in balance. So now, my accounting equation is in balance. I have asset, which is equal to no liability, only equity, 100,000. Now my debit is also equal to my credit. Now what's going to happen in the ending balances? Ending balances on the cash, my ending balance is going to be $100,000. And what will be my ending balance for the owner's capital? Same thing, $100,000. What will be the difference? The difference will be the asset ending balance will going to be debit. On the liability ending balance going to be on the opposite side, credit. What that means? That means that the money that the company has, they don't belong to the company. They belong to the owner. That's his capital. So if the owner says, I want my money back, which money? My capital. We're going to give him $100,000. We're going to close his capital. We're going to close the cash, and the company is gone. Simple way to remember it. Again, basic accounting equation, asset equal to liability and equity. Next thing that you have to do is when the sign of the equality is on the top, draw the line, sign equality, drop the line down. And put here debit, and put on the other side credit. So what that means is, simply this means if the account belongs to the asset, normal balance is debit. So every time when you put something on the debit side, that's going to increase the balance. Every time when you put something on the credit side, that's going to decrease the balance. On the other side of the equation, liability and equity is going to have normal balance credit. What that means, every time when you put the credit on these accounts, that's going to increase either the liability, either the equity. Every time when you go on the debit side, that's going to decrease either liability, either equity. Make sense? Now, how are we going to get the ending balance? That will be another thing. How are we going to get the ending balance? Ending balance, we're going to get it very simple. Ending balance, we're going to be the beginning balance plus the debits during the period, always going to be equal to credit during the period plus ending balance. That will be very simple formula how we to calculate the balances in each account. As long as the account is asset account, the formula will be beginning balance plus debit equal to credit and ending balance. What will be the formula on the other side of the equality? If we go to the liability and equity, where the normal balance is credit, then it will be different. Then it will be beginning balance plus the credit always is going to be equal to the debit plus the ending balance. So what we're going to change? We're going to change the orders. So you always have to remember on which side of the equation I am. Am I on the asset side or the liability and equity side? So let's see how this one works exactly in reality. How this exactly works in reality. Imagine this. You have in your pocket $5. You withdraw $100. You went to Metro Town and you spend $80. How many dollars you have in your pocket? I have answered 25. Do we have confirmation of 25? Again, you have $5 in your pocket. You withdraw 100. You went to Metro Town, you spend 80. How many dollars you have in your pocket? Everybody see that 25. So let's see how the actual application will be and on this formula. Let's go here and let's start working. First, in the very beginning, I have $5 cash in my pocket. Then I withdraw 100. Then I spend 80. How many dollars I have? 5 plus 100 is 105. Minus 80 is going to give me 25. So I can put a formula here. That formula will be beginning balance plus debit minus credit, it's going to give me 25. From where that formula came from? Well, from this formula. We have our basic formula, which is very important now. So what we're going to do? Beginning balance is 5. I can plug the numbers. 5 plus, let's see if the formula works. 100 should be equal to 80 minus ending balance. I don't know how much the ending balance is. So how much will be the ending balance? If I have to express the ending balance will be equal to 5 plus 100 minus 80. Make sense? Let's try again. If this makes sense, let's try again. Now I'm going to ask you a different question. Pay attention for the details, please. You have in your pocket $20. You withdraw $200. You went to Metro Town, but you don't know how much you spent. You went back home and you check your pocket and you found in your pocket $40. How many dollars you spend in Metro Town? How did you calculate it? Well, the same idea. We have 20. We withdraw 200. Now, we don't know how much we spent in this case. But we know that my ending balance now is $40. So what I'm going to do, I'm going to substitute in this formula. What I'm going to do? 20 is what I have. Plus 200 is what I get. Should be equal to credit, which I spent, but I don't know how much I spent, minus ending balance, which is 40. So the question is, how much is my credit? That's all we have to do. We have to figure out how much is my credit. So credit will be equal to 20 plus 200 minus 40. And that should give you 180. So if we get here to the formula, that will be 20 plus 200 minus 40. It's going to give us 180. Make sense? Awesome. That's how difficult accounting is. So if somebody tells you accounting involved a lot of calculation, totally agree. So how are you going to figure out? Just go to Metro Town. What do you have to do? Just go to Metro Town. Spend some money. That's your accounting, people. That's how difficult accounting is. That's how much calculations we have to do with accounting. So what we have to do? On the asset account, what's my beginning balance? How much I purchase? How much I spent? How much I have? Inventory. How much was my beginning inventory? How much I purchase? How much I spent? How much I have? Another application, if you don't want to go to Metro Town, let's say right now I cannot go to Metro Town, right? I cannot walk. I cannot go to Metro Town. So if my teacher now give me this example with $5 in my pocket and withdraw 100 and go to Metro Town and spend this and see how much we have, I cannot do it. So how can I understand accounting? Well, there's another interesting way to understand accounting. Very simple. What you have to do? Go to your fridge. Open your fridge. Imagine this. You go into your fridge, open your fridge. You see you have a milk. Okay. The jug of milk of 4 liters, you see that you have left 1 liter. Okay, it's Friday. That means the kid's gonna drink a lot of milk on the weekend, so I better go and buy milk. So you're buying a new jug of milk, which is 4 liters. On Tuesday, you're checking and you see that you have 2 liters left milk. The question is, how much milk the kids drink during the weekend and the first 2 days of the new week? What you gonna say? Again, you have 1 liter milk. You purchase one new jug, 4 liters. You check, after a few days, you have 2 liters. How many liters milk do kids drink? 3. Another way to do accounting. There's so many ways. Imagine this. I saw my wife. She purchased. She gets lettuce or lettuce which come 8 pieces in the box from Costco. So 8 lettuces in one bag. Imagine this. You purchase one bag with have 8 lettuces. 3 days later, you checking. You have only 3 lettuce left. How many lettuce was eaten? 5. How many left? 3. Why there 3 left? Because you purchased 8. This is accounting. This is what we have to do as an accountant. We have to keep track of what was purchased, how much was used, how much is left. Now, on the other side, when you purchase the lettuce, what's happened? You purchase 8 lettuces. Before you didn't have lettuce, now you have lettuce. But you sacrifice something, what you don't have now. Cash. Make sense? So that's why when you start business, you need cash. Because you won't be able to buy assets if you don't have cash. If you have cash, then you can convert cash into the assets. But from where the cash gonna come? The cash gonna come either somebody has to invest. In this case, the owner invests $100,000. Now the company can start spending cash, or we have to borrow it. Once we borrow it, then we can start operation. And then we're going to start this calculation here and going to Metro Town or open the fridge and whatever works for you. And in order to find out what we get, how much we spend, how much left. And we can do the same thing for the liability. Let's pretend now. Fido send you a bill for your telephone. The bill is $100. What do you have now? Bill that you have to pay. What's this for you? Liability. How long this gonna stay as a liability for you? A month. And what's gonna happen after a month? We have to pay. So what's gonna happen? Liability is gonna disappear. But something else also is gonna disappear. What's gonna disappear?
Cash.
Cash. Make sense? In the beginning, you have a bill, but you didn't pay it, so you have the cash. Later on, you don't have the bill because you paid the bill. Now you don't have the cash. So do you want to keep track of all your liabilities? Do you want to know how much is the total liability? Yes. Why? Because you want to make sure that you have that amount of cash available. What if you don't have that amount of cash available? Then you have two options. Either you're going to get an investor to bring more cash, to invest cash in your organization or in your household, or either you're going to generate revenue. Once you generate the revenue, you're going to have the cash because usually the employer always pays. You don't have a accounts receivable from your employer. How many of you have accounts receivable from your employers? The payroll date comes and the employer says, I'm sorry, I'm going to give you, just put it on my account. I'm not going to pay you this month. I'm going to put it on my account. And when I have cash, I'm going to pay you then. Is this going to happen? No. So that's why when you're working, you always get the cash. So once you have the cash, then you can pay. But the cash is revenue, right? Because once you get that revenue, the Canada revenue is going to ask you, hey, how much revenue you make last year? And you're going to say, why are you so concerned about my revenue? Well, because I also want revenue. And that revenue is going to come from your revenue. So make sure you make more revenue so you can get more revenue. Right? And then you're going to say, well, how this is fair? And they're going to say, well, I'm a Canada revenue agency. Well, from where do you think I'm getting money? From your revenue. You're making revenue, I'm making revenue. You're not making revenue, I want to make sure you're making revenue so I can make more revenue. Right? So that's your accounting, basically basic accounting. Let's go back now to the slides and let's see how I can entertain you with the slides now. After all this, how is this? Is this understandable now? Okay, let's go now to the slides then. T accounts. Let's repeat this with the T accounts. We're going to have a left side and we're going to have a right side. Now, a long time ago, when I become accountant, when I graduated, and get my diploma. I have a master's in accounting. Do you know that? I have a master's in I actually studied 6 years, 6.5 years to get that master's. Accounting, only accounting. Imagine this. I know all the accountings. Accounting for small companies, for big middle companies, big companies, private companies, public companies, investment funds, insurance company, bank accounting, you name it. Do you know what accounting they never teach you here in Canada? Bank accounting. I had 3 subjects on the bank accounting. Only bank accounting, which bank accounting is very interesting. I'm going to explain a little bit later, but I want you to have a little bit more knowledge on this because you have to deal with the bank accounting when you see your bank statement. And then you're going to ask me something interesting, but not now. I'm going to tell you a little bit later what will be the question that you're going to ask. But anyway, so when I graduated, somehow I convinced my sister to become accountant too. But she had a very big problem with this debit and credit concept. So she went to one friend of ours, and he explained to her debit and credit in this way. He said, imagine in the left pocket you have the money. On the left pocket you have the money. On the right pocket you don't have the money, so you have to move it. The right pocket belongs to you. Left pocket belongs to the person that you have to pay the money. So what you have on the debit side, when you have it on the left pocket, it's your on the left pocket is yours. When you move it to the right pocket, it's gone. So left, right. So always remember, when you're getting with the left pocket, cash going up. When you're going on the right pocket, that means cash going down. That's how you should remember when you have an asset account, debit and credit. So that will be the easy part. Or the other thing is that there's so many different explanations on debit and credit. But again, it's very important you to stay on the accounting equation and understand which account we're talking about. Are we talking about the assets account and we're talking about liability and equity account? Because debit on asset account means increase, credit on the asset account means decrease. If you go into the liability and equity, credit on liability and equity means increase, debit means decrease. So let's keep going with this. And again, a repetition of this that I just said. On the assets account, since on the one side of the equation, asset, as long as it's asset, normal balance always going to be debit. Picture yourself this chart here, but draw the line down right here. That's the account, debit, credit. So asset, every time on the debit, we adding debit on the assets, that means increase the asset. Every time when we credit, that means decrease the asset. Liability is and equity is the opposite. Every time when the company get a receipt but don't pay for it, that's going to increase the liability. And every time when the company use the cash to pay the liability, that's going to decrease the liability on the debit side, but it's going to decrease our cash too. Same thing with the owner's equity. Every time when the owners put the money in the company, cash going to go up, but the owner's equity is going to go up too on the credit side. Every time when the owner take the money from the company, that will be debit for the owner, but will be credit for the cash. Owner's equity is going to go down, but the cash also goes down. We're going to practice a little bit with this so you can get the sense. So let's see the journal entry here. This Lisa invested $250 cash. So what that means? That means the equity goes up. On which side? On the credit side. So we're going to open this capital account, credit for the increase the equity, and debit to increase the cash. Now the company has cash now. Next one will be with the cash that she had, the $250, company purchased land. Now what's going to happen now? Before we purchase the land, we have 250 cash. But once we purchase the land, now we have the land, which is 100, and we don't have cash for the same amount. So what's happened now? My cash went down with 150, but my land went up with 200 or with 100. Total, I have assets of 250, which is exactly equal to how much the owner invested. So again, in the first transaction, capital goes up, cash goes up. In the second transaction, no change in the capital, but cash is converted into land. Now, total assets is 250, or total debits 250, total credits is 250 as well. So we keep the accounting equation in balance and we keep debit and credit in balance. That will be our objective in this course. We to keep everything in balance. That's why it's called balance sheet. That's why I kind of like accounting, because in accounting, everything is in balance. What you get is from what you did. If you did nothing, you get nothing. If you did good things, you get the good things. If you're doing the middle things, you get the middle things. So what is going to happen if we put it on the big picture? In the big picture, now it's getting too complicated, but simple thing is asset is equal to liability and equity, which we saw last time. Now from this time, asset always going to have debit balance. Liability and equity always going to have credit balance. On the asset, everything on the debit side is going to give an increase the asset. Everything on the credit side is going to decrease the asset. On the liability, everything on the credit side is going to increase the liability because we have to pay it. Every time when we pay it, on the debit side, it's going to decrease it. Now the owner's capital. Every time when the owner invests the money in the company, his capital is going to increase. Every time when the owner withdraws money from the company, his capital is going to decrease. On the revenue and expenses, every time when the company generates revenue, that's going to increase the owner's equity. That's going to go on the credit side. And every time when the revenue goes down, that will be the debit side. Expenses are the opposite. Expenses on the debit side, it's going to decrease the owner's equity. And on the credit side, it's going to decrease the owner's equity. Actually increase the owner's equity. So, but the expenses on the debit side always going to be increasing. On the debit side, it's going to be, credit side is going to be decreasing. So now let's go back to our chart, our textbook, our Excel spreadsheet, so I can explain this with the revenue and expenses account. So we did this with the balance sheet accounts. Let's go a little bit down and work with the income statement. On the income statement, again, we're going to have these accounts, which are cumulative accounts. On those accounts, we're only going to chase how much is the accumulation on the period. Let's copy this and let's paste it. No, I don't want to copy all of that. I want to copy all of this and gonna paste it here. So for the income statement, we're gonna have two accounts. One will be the revenue. And the other one will be expenses. What do we know so far? We know that every time when the company generates revenue, that's going to increase owner's equity. On which side owner's equity increasing? On the credit side. So for that reason, revenue always going to have a credit balance. So for the revenue, now we're going to talk about later again, for the revenue, every time when you see revenue, its increase comes on the credit side because it's part of the equity, increasing the equity. Anything on the debit side of the revenue, that's going to be decrease. Now, what's going to happen with the expenses? Well, the expenses usually reducing the owner's equity. And the owner's equity is reduced on the debit side. But expenses, since we're looking for accumulation of the expenses, every time when we see debit expenses, we're going to debit that account. We're going to increase that amount on the debit side. And every time when we see credit on the expenses, that's going to reduce our expenses. Simply, we're going to chase here increase and reductions on both. So for that reason, revenue, remember, always credit balance. expenses always debit. Now, at this point, it's getting a lot to remember, but with the practice, once we start applying everything that we learn, you're going to see it's kind of getting, at some point, it's going to start getting natural. So let's see, normal account balances, the normal account balances again. Asset, debit, liability, credit. Capital, owner's capital, credit. Revenue, credit. Expenses, debit. Now we're going to add a new account, withdrawal account. Normal balance with the withdrawal account always going to be debit. One way to memorize it, don't memorize it. my strongly suggestion is don't memorize it. Don't rely on memory. Rely on logic. Logical thing, you can recreate it and you can naturally come to it. Memorization, you can forget it. Every time when you forget, what's the normal balance of the asset? What I want you to do is draw the accounting equation. Make a T account, draw the line where the equal sign is. If it's on the debit side, so in that case, left will be debit, right will be credit. If the asset always going to fall on the left side. So that means normal balance is debit. Liability equity always going to fall on the right side. That means normal balance is credit. That's how simply you can remember it. And then you don't have to memorize it. The only thing that you have to memorize is revenue always credit, expenses always debit. End of the story. So, from where we're going to get those transactions? Transactions, we're going to have some documents. What will be the documents? Well, different documents. For the bank, we're going to have a bank statement. When we deposit money, we're going to have a deposit slip. When we're spending money, we're going to have a bank check. For the purchases, we're going to have a receipt, we're going to have a purchase invoice, we're going to have any kind of things. For the sales, we're going to issue sales invoice. That will be the document that's going to state the customer name, customer address, all the things, what we're selling, how much is the unit price, how much is the total price. Same thing with the purchase invoice. You're going to have the document that's going to state the company that's selling you, how many items were bought, what's the item single amount, what's the total amount, how much taxes you have to pay, total amount. Everything will be there. Then once we have that document, then we can start journalizing the transactions. How are we going to journalize the transaction? Chronological order. When you bring your bank statement, you're going to see everything that's going in your bank statement is on the chronological order. What means on the date that happened first. The bank doesn't show you May 1st, this month, May 31st, that much, then May 12th, this much, then May 22nd, this much, May 3rd, that much. It doesn't go that way. It doesn't even go with which one amount is higher, which one is lower. It goes chronological order. From day 1 to day 31st in May. From day 1 to day 30 in June. And keep going the same way. So what will be the process of journalizing transactions? First, we identify, is this transaction is from the source document? Is it from the receipts? Is it from the sales invoice? Is it from the bank statement? Is it from where is it? Second, we're going to identify which accounts are involved. Is it asset account? Is it liability account? Is it equity account? Is it revenue account? Is it expense account? What exactly is? Next thing that we have to keep in mind is to keep asset equal to liability and equity all the time. And when we're making the journal entry, simple thing that we have to remember is to keep debit equal to credit. Same thing like a asset equal to liability equity. Same thing, debit always equal to credit. Whatever comes in, that much goes out. Whatever comes in, that much goes out. They have to match. When you go to the store and purchase, when you go to the gas station and put 20 liters of gas, you have to pay, right now you have to pay probably $15. So you get 20-liter gas coming in the car, and you're getting $15 getting out of your bank account. Something coming in, something going out. Now, you're not going to see the 20 liters gas because the car is going to burn the gas, obviously, and you're going to see the $15 going out from your bank account, but life is not fair. What can I say? So how are we going to do those journal entries? Journal entries, we're going to have this journal, which journal is going to have this kind of interesting columns. One column always going to have a date. Next column is going to have accounting titles and explanation. Then you're going to have debit, and then you're going to have credit. This is what you have to do on your first test in class, actually. But since we haven't done it yet, let's do some practice first, and then you're going to be ready for that first test in class. One of the questions is you have to show me simple, very simple journal entries, and I'm going to show you what the entries and how to do it. So what's the next step? Next step is just start working on the journal entries. On the T accounts, we're going to start putting debit and credit. That's our next step. And after we do the debit and credit on the different accounts, on the so many different accounts here, you're going to see cash, you're going to see land, you're going to see cash, you're going to see land, you're going to see this, you're going to see that, all the things. What we have to do at the end, we have to prepare a trial balance, which will be the summary of all the accounts that we have on one sheet, and going to tell us only the ending balances. On the journal, we're going to see what's coming in, going out, coming in, coming out, going in, going out. But on the trial balance, we're going to see only the ending balances and nothing more, nothing less. Make sense? So the trial balance is going to look like this. We're going to see on this date, on this specific date, we have that much cash, that much receivable, that much office supply, that much land. We owe accounts payable that much. For the owner, we owe that much. Owner withdraw 6,000. Our revenue was 55,000. Expenses 4,000. Salary expenses, utility expenses. Total debit always have to be equal to the credit. Why? Because every time when we're doing the journal entry, we keep it the same. Debit equal to credit. And that's all. That's how simple it is. Or that's how difficult the accounting is. So, mistakes. There are always going to be mistakes, believe it or not. The most common mistake, do you know what's the most common mistake? Let me stop sharing this. And let's go to Excel spreadsheet. The most common mistake is transposition mistake. For example, you have to punch the number 378, right? That's the 678 is the right number. Let me make it bigger so you can see it better. 678 is the right number. But for some reason, you punch 687. It's happened to me, still happening to me. It may happen to you. How can you find out that you have a mistake? Very simple. Check the difference. So how are you going to check the difference? Between this amount and the other amount, you're getting the difference, this one, minus that one. The difference is 9. As long as the difference end of number 9 is transposition error, that means you flip the numbers. So let's see another example. Let's see, we have 57 and the other one is 75. What's the difference? The difference in this case is 18. But 18, when you bring it to the simple numbers, it's going to be 1 plus 9 plus 8. And that's going to be equal to 9. As long as it's 9, it's transposition error. The other one will be example 2354. And the other one will be 2534. Let's see what's the difference. 180. That can be broken to 1 plus 8 plus 0 equal to 9. Transposition error. And that's always going to be true. Break it, see the differences, break it to the simple numbers, see how much is it. If it's the number is 9, you have transposition error. This one is like playing with the numbers and simple math. One of those math gimmicks that they usually chasing the kids with that. So now, what's next for us here? Next for us here is we to go back. Now I want we to go back to the first chapter, and I'm going to go to the Blackboard, and I'm going to start pulling documents from the Blackboard. Let's go to course content together. Before we start doing that, no, it's too early. Do you want break now or a little bit more than break? How do you feel? Are you feel tired? You're not saying anything, so we're gonna keep going then. Let's go to Blackboard. When you need a break, let me know. So let's go to chapter 1. And let's go to the case for practice. And let's pull question 1-1. So let's see what's here for us. You can download that question. If you haven't downloaded it yet, download it on your computer. And let's open it. And let's see what's in that question. That's a very simple question. That's mostly about financial accounting and managerial accounting and taxation accounting. So let me share my screen. And let's do it together. So from those three options that we have, financial, managerial, and taxation, for each of the following responsibility, identify area of the accounting that most likely involve the responsibility. If you see financial statement for external users, that will be, which one will be that? Financial, managerial, taxation. Financial, yes, A. Planning transaction to minimize tax paid. Most likely that will be taxation. right? Because everything is involved with the tax paid, that would be that. Cost accounting. Accounting that dealing only with cost, nothing else. Management accounting, definitely. That's another term of the management accounting is cost accounting. Preparing financial statements. That will be A. Financial statements will be preparation will be A. Yes. Let's go review financial reports for compliance with the Provincial Security Commission requirements. That will be financial. Why? Because we are applying to the external users, right? Every time when you see external users, that's for the financial reporting, financial accounting. Budgeting, management accounting, all over it. Internal management reporting, management again. Investigating violation of the tax law, that's obviously what is going to be. Okay, that was easy. Let's go with the next one. Next one will be number 2, right? That's number 1. Let's go with number 2. Again, the same place, case for practice. Let's pick question number 2, 1-2. Download it, and let's see what's going to happen here for us. Gonna open it. So this question is interesting question because something similar you're gonna have on your test in class. You're gonna have a different accounts. With the balances, right? And then you have to calculate something. Either assets, either liability, either equity, either expenses, either the revenue, either owner's equity. That's what you have to calculate. So again, you're going to have those different accounts and you have to say what is this? How much is from the question is going to say, calculate the total expenses or calculate the total liabilities or calculate the total revenue. So before we do that, now let's go over another document. Let me see if we go to I just want to check something. Just give me a second. I want to see what's the question 3 first. I want to prepare you first for something, and then no, question 3 is the entries that we have to do. Before we do this question, let's do some other things. Let me share this. Let's go to Blackboard. We're going to come back to this question. I'm not going to forget about this question. We're going to come back to this. But before we do this, I want we to go to do I have it here? Did I post it to account transaction format? Practice question. I want to see where did I post you something that you can see. No, that's not what I want. Solution of chapter questions. No, that's not what I want. That's 52 pages. I think I didn't post you anything here from class PowerPoints. I see. Oh, yes, because I'm printing those, I'm giving you those in class. So, okay, I'm gonna open my screen then, on my screen, and I'm gonna give you some questions for and we're gonna go and talk about this, and I'm gonna post you those one on Blackboard as well. but after we finish today's class. I don't want to spend now posting those ones. Before we do the question with the calculation. Now, let's do this question together. Can you guys see my screen? Okay, so let's go now with this question, and let's do it together. So here you have these options. From the accounting equation, you have assets, liability, equity, withdrawal, revenue, expenses. Let's figure out which account belongs to the assets, which accounts belong to liability, which account belongs to the equity, which account belongs to withdrawal revenue expenses. Simple rule is this. Every time when you see expense, most likely will be expense account, unless it's a prepaid expense. If it says prepaid expense, then that account is asset account. But everything that doesn't say which is pure expense is expense account. Every time when you see payable, liability account. So let's go, having that in mind, let's go. Building, what account will be that? Building definitely will be asset account. Building repair expense, expense account. Wages expense, expense account. Wages payable, liability account. Not receivable, asset account, correct. Not payable. Now, watch this. I'm going to add here advertising expense. Now, prepaid advertising expense is asset account. Even if it says only prepaid expense, still asset account. So be careful with this one. That one will be the trickier one on your test, because it's going to say only prepaid expense. Next one, advertising expense. So do you see the difference between now prepaid advertising expense and advertising expense? One is the prepaid. So basically, what's the idea with the prepaid account? Prepaid account is that I'm prepaying for the advertising, which is going to happen next year. But since it hasn't happened yet, anytime until this year, I can cancel that advertisement. So they basically they owe me money. Since they haven't performed the services for me, they owe me money. Make sense? So that's why I want you to pay attention when it says prepaid and when it says advertising expense. Advertising payable. Yes, that's a liability. Let's go with this one. Unearned advertising revenue. Unearned advertising revenue is also liability account. Why? Because they pay us, but we haven't done anything yet. So for that reason, we owe them money. Advertising fee earned. That will be revenue, yes. Revenue, not asset, revenue. When we earn something, that means we earn it from the normal operation of the business. Once we earn it, that's our revenue. Interest earned, clearly revenue. Interest expense, expense. Interest payable. Now watch this. Earned subscription fee. We earn them. Unearned subscription fee. Liability. What makes it liability? Because it hasn't been earned yet. Prepaid subscription fee. Asset. And then we can have a subscription expense. That will be expense, right? Supplies. How about supplies expenses? Rent revenue. How about unearned rent revenue? That will be a liability. Why? Because we haven't earned it yet. Right? Since we haven't earned it, so again, every time when it's revenue, it's going to be revenue. But be careful, is it earned or not earned? If it's unearned, a liability. If it's earned, revenue. Prepaid rent. Rent payable. Service fee earned. Clear revenue. Withdrawal. That will be withdrawal account, right? How about owner's capital? Equity, pure equity. Salary expense. How about salary payable? Furniture and equipment, both assets. Okay, good. That's good. So the other thing is, let's do one more question here, and then I'm gonna let you do the question with the calculation. I want you to see one more question. Let me see if you see what's the screen that you're seeing. Okay, you're not seeing what I want you to see. Let's move to the next one. This one. So first, what I want you to do is first on the first column, first we're going to indicate, is it asset, is it liability, is it equity, is it revenue or expense? And then we're going to say, what will be the normal balance? Is it debit, is it credit? Equipment. Let's go with the equipment first. First, what is it? That's asset. No questions about it. What will be the normal balance? For the equipment. Debit. Yes. Land. Asset debit. Yes. Withdrawal. That will be the withdrawal account. Normal balance is debit. For the withdrawal, normal balance is debit. Rent expense. Rent expense is expense account. Normal balance is debit. Yes, it's going to hit the equity, but before we hit equity, we're going to keep it as expense. Interest revenue. Revenue credit account. Credit balance, yes. Prepaid rent. Okay. Asset debit, yes, that's correct. Accounts receivable. Asset debit, yes. Office supplies. Asset debit, yes. Not receivable. Should be the same, right? Okay, how about not payable? Okay. Owner's capital. Okay, equity credit. Rent earned. Rent payable. Okay. Liability credit, yes. Interest expense. Expense debit, yes. Interest payable. Okay. All right. Now we can go to the question 1 with the calculation. So now once we know all this information, now we can go to this question, and that question now is going to make sense. So what we have to do is first match each number item with the part of the balance sheet. Is it going to be asset? Is it going to be liability? Is it going to be equity? Or doesn't appear on the balance sheet? We're looking only on the balance sheet, right? So let's go with the net loss. Net loss is not going to appear on the balance sheet, so there will be nothing there. Net loss is simply calculation, doesn't appear anywhere. Rent expense. It's expense and doesn't appear on the balance sheet. Correct? But the normal balance will be debit. Rent payable. That's on the balance sheet. So it's going to be what? Rent payable. Liability. Yes, that's correct. So accounts receivable. Asset, yes. Investment in May. Owner's investment made in May. That will be equity, correct? Interest revenue. That's not going to be on the balance sheet. That's a revenue account. Owner's capital at the beginning of May. Equity. Repair equipment. Repair supplies. That will be asset, correct? Not payable. Liability, correct? Owner's withdrawal. That's part of the equity, correct? Truck. Asset. Consulting fee earned. That will be revenue, right? And capital at the end of May, we have to calculate it, and cash will be asset, correct? Okay, so the next thing that we have to do is prepare the income statement of changes of equity on the month of May. How are we going to pull that one? Now, on the question that you're going to see in the class, it's going to ask you how much are the expenses. So what you have to do is to pull out the expenses. Which are the expenses? Rent, is this expense? Rent expense, is it expense? Yes. So we're going to pull the rent expense. What else? Interest revenue, is it part of the income statement? It should be. right? So let's mark it with red. What else? Consulting fee earned, right? Anything else that will belong to the revenue and expenses? Nothing else. We're chasing only revenue expenses. Is there anything else? So the question is, how much is the net income? -2. Can you see it? So what we're going to have? We're going to have consulting fee earned $8, interest revenue $2, rent expense 22, net loss is $2. So here on the net loss, we're going to have -$2. Oops, -$2. Okay, so next thing that we have to do is the owner's capital. Now, the owner's capital, you have to do it on the test which coming in the class. So how are we going to do the owner's capital? First, we're going to see beginning balance. Then we're going to get how much he invested. Then we're going to add the income. In this case, we're going to add the loss. And then we're going to deduct the withdrawals. Remember the order. Beginning balance plus the investments plus net income minus net loss minus withdrawal. It's going to give us the ending balance. How much is our ending balance here? $33. Let's see. We have 0 plus 30 minus 2 minus 5. 23. Make sense? And the next thing is to see how much assets we have and how much liability we have. So if we have to prepare the income statement, it's going to be consulting fee, interest revenue, 20 minus rental, net loss is $2. Statement of changes of equity, it's going to be capital plus the investment minus the withdrawal minus the net loss, it's going to give you 23. And if we have to prepare the balance sheet, we're going to add the cash, accounts receivable, repair, supplies, and truck. On the other side, we're going to have rent payable, not payable, and owner's capital. It's going to balance the balance sheet. Make sense? Okay. How are we feeling on the break? Or we keep going? Keep going? Break. Okay. Okay, let's have a break like a 10 minutes and we're gonna keep going. In this exercise, objective is we to find what do we need to do in order to increase or decrease whatever says on the balance. Do we have to debit it or we have to credit it? So before we do that, first we have to understand what kind of account is this? Is it asset account? Is it liability account? Is it equity account? Is it revenue account? Is it expense account? What exactly is? So once you have that in mind, you have to remember asset increase on the debit side, decrease on the credit side. Liability equity is opposite, increasing on the credit side, decreasing on the debit side. Revenue always increasing on the credit side, expenses always decreasing on the credit side, so that means increasing on the debit side. So the expenses increasing on the debit side, decreasing on the credit side. Having that in mind, let's try to do this one. Now we want to increase not payable. First, what kind of account is not payable? Liability. How can we increase the liability? On which side? On the debit side or credit side? On the credit side. Yes, that is correct. Let's go with the next one. Accounts receivable. What kind of account is that? Asset account. So if you want to decrease the asset account, we have to put credit. Correct. The owner's capital account. Obviously, that's an equity account. We want to increase it. On the credit side, it's going to be increase. That's correct. Now let's go with the unearned fee. Every time when we see unearned fee, that means we haven't performed the services. So that means a liability. We want to decrease it. We have to apply debit. That is correct. Prepaid insurance expense. That's an asset account. We want to decrease that account. We have to put credit, correct. Cash. Asset account. We want to decrease the asset. I mean, they want to decrease the asset. I don't want we to decrease the asset. Okay. Utility expenses. Expense account. And we want to increase debit side. Fee earned. Revenue account. And we want to increase that fee revenue earned. Credit, correct. Store equipment. Asset. We want to increase debit. Now careful with this. Withdrawal is special account. The withdrawal the normal balance is debit. So every time when we want to increase it, we have to put debit. So with the withdrawals is the withdrawal account. That's part of the equity account. If you want to increase it, that means we have to debit it. Rent payable. And we want to decrease that liability account on the debit side. Prepaid rent. Asset. So we want to decrease that prepaid rent on the credit side. Supplies. Okay, office supplies. We want to increase the office supplies. Debit. So, question for you. If I increase the office supplies, that means I have to decrease something. Which are the options for me for decrease cash? Do I have any other options for decrease besides cash? Why are you going with the revenue? If you put it on the revenue, that's going to increase the revenue. Well, I want to increase the supplies. Revenue is not an option, only cash. So is there option for me? So listen to me carefully now. I'm increasing supplies. So forget about the revenue. Revenue is not an option here. I want to increase the supplies. So I'm increasing the supplies. On the other side, which account I can increase? Payable. That is correct. Expense on the credit side. So watch this. Supplies is going to increase on which side? Debit or credit? Debit side. So if I want to increase something, on which side I have to increase it? On the credit side. Which account is going to increase on the credit side? Which account's increasing on the credit side? Liability account. Make sense? So what will be that? Payable. Make sense? So let's now increase the supply expenses. That will be expense, debit side. Obviously, on the other side, again, my options is to decrease cash or to increase liability. I don't have any other options on the office supplies expenses or office supplies if I want to increase those two. Now let's decrease accounts payable. Debit on the liability. Now listen to me carefully. If I decrease the accounts payable, that will be on the debit side. On the credit side, which account I have to decrease? Think about it. You have to pay FIDO bill, which you want to decrease it. So you put it on the debit side, so you're decreasing FIDO bill, but you have to decrease something else on the other side. Cash, that's correct. Now, the other thing is, listen carefully again. It's a tricky question now. If I decrease accounts payable so accounts payable is liability account, right? When I decrease it on the debits, I'm decreasing it on the debit side. Now, so to balance it, I have to go on the credit side. Can I decrease accounts payable and increase other account? Is it possible? Means on the credit side, which account increasing on the credit side? Which account is going to increase on the credit side? Which balance sheet accounts? Which belong to liability and equity, correct? So what will be the account that we can use so I can decrease accounts payable but increase on the credit side. Which account should be that? Supplies and equipment, that will be asset account. That's not going to work. If we're paying accounts payable with the supplies and equipment, which will be very unusual, that will be expense. It's not going to be cash. Will be if we're doing credit cash, credit is going to decrease. I'm looking for increase. Equity, yes, the owners can bring the equity and pay that's accounts payable. That's a good choice, Brian. But I'm looking for also for something else. Accounts receivables is an asset account. So if you use accounts receivable to pay accounts payable, accounts receivable is going to go down on the credit side. So we're not using accounts receivable to cover the accounts payable. I told you this is a tricky question. Brand, get it. One option is to get the equity. What's the other option? Which increasing on the credit side? No. Yes, revenue increasing on the credit side, but in this case, the revenue is related to the net income. We're not using it. What will be the other option? One more left. Capital, we already say equity. What's the other option? No. One more option. Liability. That's correct. So what we can do is I can set a one liability with another liability. Can I do that? Are you guys with me? Can I pay one liability with another liability? Can I borrow money from the bank and pay my accounts payable? Yes. That's what I wanted you to come up with. Yes, and one way to decrease accounts payable and increase bank loan. I can get a bank loan. That's going to increase the bank loan. And we're going to pay the accounts payable. Now, accounts payable is related to something like a FIDO bill, like an electricity bill, something related to the operation of the company. The bank loan is something that you're chasing on the long term, right? So usually the company doesn't borrow money to pay operating expenses, but in this case, that's why I told you it's a tricky question. I wanted you to think outside of the box and to come up with the way to reduce the accounts payable and increasing something on the credit side. And the option to increase, Brian, get it right. One is to owner to invest money, and the other one is with another liability. Keep that in mind. That's interesting thing. So let's go with another question. Let's see what I have. What else I have as a question for you. Let's go with back to Blackboard. Let's go back to Blackboard and use one of the questions on Blackboard from chapter 1. I saw in chapter 1 we have one interesting question there. So what I want you to do is go back to the contents on chapter 1 on the case for practice and go to question 3, 1-3. And let's download this one. And let's do the journal entry for this. Now we're gonna start for the first time. We're gonna do the journal entries with you. Let's see how you're gonna respond to that one. Let me share my screen so you can see the question. So there's a chart here on the question below the actual question that we can fill up. But what I'm mostly chasing is the accounting journal entries, debit and credit. So for that reason, what I'm gonna do, I'm gonna copy this one. Or we can do it like here. Let's do it here first, and let's do the journal entries after. Deal? Let's go with first. Owner invested $25,000 cash. First, this providing support for the customer in area of e-commerce following the activities that happened in some March this year. Owner invested $25,000 cash in business. So what's going to happen now? Which one is going to increase? Which one is going to increase? Cash increasing with 25,000. And capital is going to increase. The owner's capital is going to increase with same amount, 25,000. Correct? We're going to go to debit and credit. Then I'm going to copy this and we're going to move to debit and credit. B, owner purchase office equipment on credit or on account for $600. So what the company get? Equipment for $600. And what else they get? They increase something else, liability. They get liability. Before they didn't, you see, at this point, they don't have liability, but now they have liability. So the liability increase. So now they, with the cash that they have and the equipment that they have, what they have? They have outstanding liabilities and outstanding owing to the owner, correct? Next one. They order furnitures for $700 on account. What we're going to get? We're going to get the furnitures for 7,000. And since we didn't pay, we have to show that our liability increased with 7,000. Okay, so, but that will be not here, that will be in the next line. Let's cut it from here and paste it here. Next one. Careful, this is a tricky one. They completed application for 10,000 government grant. What did they get? Again, they complete the application for government grant for $10,000. What did they get? Nothing. So basically, watch this. You completed application for you completed application to be accepted in UBC, which can guarantee you grant of $10,000. How much do you get? Nothing. It's just application, right? For filling the application, you're getting zero. So now that's why I told you it's a tricky one. So now let's see, the owner paid for the office supplies in B. So what's happened in this case? We purchased the office supplies on account, 600. Now we're paying them. What's going to go down and what's going to go down? Going down cash, 600. And going down, liability going down with 600. Since we paid it. And the last one, owner withdrawn $1,250 cash. So what's going down? Equity going down and the cash going down with the same amount. So cash going down with 1,250, and that's negative. And the owner's equity going down with the same amount. Okay, we did this. Good. So now let's go 500 and let's go and do the journal entries for this. So I'm going to copy this one and I'm going to move to the Excel spreadsheet. Okay. Let's use the Excel spreadsheet that we already have. I'm going to post it there, paste it there. Let's see if it's pasted. Yes, it's pasting perfectly. And let's do now the journal entries. And let me share my screen. And that's the screen. So now, let's go one after another. First journal entry for today. A. It's going to be which account we're going to debit, which account we're going to credit. We're going to debit credit, we're going to debit capital, correct? Sorry, debit capital. We're going to debit cash for how much? How much cash we get? 25,000. Okay. And then we're gonna, let's move those one here. Let's put it like this. And we're gonna credit capital with the same amount. Remember, debit has to be always equal to credit. That's transaction A. B, we purchase office supplies. So I put it in the wrong place. So that will be 600 gonna be here and 7,000 is gonna be here. So sorry, my bad here on this one. So we purchase office supplies, but we didn't pay. We purchase on the account. What's happened with B? We get something and we get something else. What we get? Debit. We get asset, right? So that's why we have to put debit on the asset. What asset? Supplies. And we get $600 supplies. What else we get? Now on the credit side, we have to increase something. What will be that? Liability, or that will be accounts payable in this case. And that will be exactly the same amount. Now the next one, same thing, also on accounts payable, on account, but we purchase equipment. So in this case will be very simple, same, debit. We're going to change instead of supplies, we're going to go with equipment for 7,000. And then we're going to get credit accounts payable, which will be exactly the same amount, 7,000. On number D, we said no entry. See D, no entry. Next one is E. On E, we paid for the supplies. So what we reduce on the debit side and what we reduce on the credit side. Think if you tell me debit cash, that means we get in cash. Did we get cash? Debit will be accounts payable because we want to reduce the liability. And we're reducing the liability on the debit side. So with the debit side will be 600. So And what's happened on the credit side? On the credit side, we reduce cash with the same amount. And the last thing that left is the withdrawal. On the withdrawal, something went out. What went out? Cash goes out. Debit will be owner's withdrawal. Debit will be owner withdrawal. Withdrawal account, and on the other side will be credit cash, which will be exactly the same, $1,250 and $1,250. Make sense? Excellent. Shall we make it a little bit more complicated? Or that's enough for today? What are you saying? You're not saying anything. Do you want another question or we're done? Let's push you a little bit more. I think you at this point we can take it. Let me push you one more. So very simple and very easy. Again, on this one, what we're doing is we're only doing the journal entries. So I'm gonna copy this, I'm gonna move to the Excel spreadsheet, and we're gonna keep going together. Very fast, very simple. So you can have one more thing. The following transaction happened in this company. First thing, the owner invested $15,000 cash into his new business. Talk to me. Debit, credit. What the business get, what the owners get. Business get cash, owners get capital, correct? For $15,000. Let's make it equal. And the credit is the capital for $15,000. Then, now the operation starts. First, the owner purchased $2,000 furnitures. What happened with that? Debit. What the company get? Office furnitures, okay. And what's the company give up? On account, that will be, now they're getting something, accounts payable. And that will be for $2,000. All right, next one. They purchase more furnitures, but now pay cash. Debit. What are we gonna debit now? Still furnitures, right? And credit this case will be cash. Cash gonna go down. Why? Because we pay cash. We get the furnitures, but compared to the previous time, now we're paying cash. $500. Now, we did the work for the customer during the normal operation of the company, and we collected cash. That's something new for us now. That's new transaction. We haven't seen anything like this before, so let's do it. What we get? First, let's debit cash. No questions about it. Let's get the cash. Once you smell that the cash coming in, get that cash right away. Debit cash. So how much we get from the customer? $1,000. Why did we customer pay us? Because we provide him a revenue. Credit revenue, correct? For $1,000. Excellent. Now, the next one, we did the same thing, but the client hasn't paid us. What will be that? Debit. Which account am I going to debit now? I'm not getting cash now. Do I have to pay it or I have to collect it? Think about it. The client don't pay me. I'm I'm the one. Now I have to receive it from the client. That's correct. So that will be accounts, but not payable. That will be receivable. That's correct. And the credit also will be revenue because we're providing the services. And that will be for $700. Excellent. What's the next thing that happened? Is we paid $500 for the furnitures. Let's pay those $500 for the furnitures. F. What will be that? Debit. Now we have to reduce our liability. Debit accounts payable with $500 and credit. From where did we get? Credit cash. In the next transaction, what happened is now the client pays us $300. The one that didn't pay us $700, now he pays $300. What did we get now? Now we get the cash. Let's get the cash right away. Debit cash. Clients bring us the cash, $300. And what we're gonna close? We're gonna reduce not the revenue. We're not providing services now. He just paying the outstanding accounts receivable that he has, right? Because that's what just I mean, it's not just introduced now. The Canada revenue wants you to make a mistake to put this one in the revenue, because when you increase the revenue, you have to pay more taxes, but we're not providing the revenue. We're just reducing the accounts receivables. Because he didn't pay us in the first place. He still owe us money. Did the client still owe us money? Yes, how much? 400. 700 minus 300, 400. Did we owe money for the furnitures? We didn't pay 2,000. We pay only 500. So how much we owe? 1,500. And the last one, we work on the clients for credit. So basically, we get another revenue, which we didn't collect the money. Let's do the last one and finish with this. Debit accounts receivable and credit will be revenue for $400. And as you can see, we can keep going with the transaction. But what you're gonna see at some point is all the transactions start to repeating themselves. Now, the challenge will be the first time when you see it, and the first time when you see it, it's you to realizing what actually happening. Stay with the transaction. Think about it. What's happening here? I'm providing services. So that's once I provide service, that's revenue. The question is, did I collect the cash or I have to collect the cash in the future? If it's have to collect in the cash in the future, that's mean the accounts receivables. If I collect the cash, that will be cash. Now, when we become accounts receivables, I don't want to stay at accounts receivables. I want to become a cash. So when the clients pay me, now I'm getting the cash, but I'm not providing the services because I already provide the services. He didn't pay me in the first place. Now he pay me the money. So that will be closing accounts receivables. Obviously, ideally, you want to close all the accounts receivables as fast as you can because you better have the cash in your hands rather than waiting people to pay you the money. Don't forget why you open the business. You don't open the business to make profit. I mean, most of the people, they say, why do you open your business? To make profit. No, that's not why you open the business. And they say, how come? Because try to go to superstore, go to the cashier, buy something, go to the cashier and say, can I pay with profit? See what they're going to say. What they're looking for? They're looking for cash. So why do you open your business? To get cash. From where are you going to get cash? From the revenue. So when the client doesn't pay you, did you get cash? No. You get accounts receivables. But accounts receivables doesn't feed your family. Cash feeds your family. So you want to convert that accounts receivable to become cash. Thank you for today. I'm sorry I keep you for 5 more minutes, extra minutes, but I hope it's worth it. Now, all these calculations and all this Excel spreadsheet will be posted for you in Blackboard, obviously, and you're going to have access to this. And the other thing that I want you to do is enjoy the rest of your day. Have a great day, great evening. After that, have a great week, great long weekend. Don't forget it's a long weekend. I know my group on Monday will not be happy because on Monday I'm still going to have a lecture. So if you want, for those of you who this going too fast, it's too much materials, and you start seeing that you kind of don't get it, Friday, same time, same place. Monday, 3:30, here, online. If you don't, Monday, I know for it's going to start holiday. There will be no lectures in Douglas College, but I'm still going to have my lecture here online. So if you don't have anything to do, if you want to listen this one more time, on Monday, 3:30, same Zoom link, everything is the same. It's going to be, I hope it's going to be helpful if you listen it 2 times, but the other option you have is the recording. Again, thank you for today. Enjoy the rest of your day. Have a great